Hello and welcome to ET Now Startup Central, India's first and only daily show dedicated to startups, technology and entrepreneurship. I'm Chandra Srikanth coming to you live from India's startup capital, Bengaluru. And we are doing a special show this evening on the one deal, the biggest deal in the e-commerce space that everyone was looking forward to, but which has now come unstuck because the founders of Snapdeal have decided to snap talks with Flipkart for a potential merger that would have been the biggest in the e-commerce space. They've instead decided to pursue an independent strategy, an independent path, something that they are calling it Snapdeal 2.0. Now, remember, this isn't coming out of the blue. Feelers about this started making their way last week when it seemed like nothing could really salvage this deal because the founders had decided that they were not ready to go ahead with this deal. In fact, on Friday, we here at ET Now reported about a stalemate situation between the founders of Snapdeal and their biggest investor, SoftBank, because Snapdeal, remember, had just divested its subsidiary Freecharge for $60 million, and that really gave them a shot in the arm, some more runway to pursue an independent strategy. And Kunal Bahl, the co-founder of Snapdeal, had indicated as much in an email to employees. Now that has become a reality because over the weekend, though there was hope that 10%, 20%, something would be done to salvage this deal, nothing could happen. So after 5-6 months of hectic negotiations on Snapdeal's side, on Flipkart's side, the deal is not going through, and that statement is a finality today. Snapdeal not only releasing a statement, but also a detailed email to employees on what the plan of action is going to be. Now, this new Snapdeal 2.0, the stripped-down version of Snapdeal, we don't know how viable it will be, but it is certainly going to lead to a lot of layoffs in the near term. People pegging it at, in hundreds of terms. We really have to see what the employee impact is going to be. Now, as far as Flipkart is concerned, remember, this was supposed to be a two-pronged deal, where in the first stage, Snapdeal would merge with Flipkart, and in the second stage, Flipkart will get a substantial investment from SoftBank. From what we understand from our sources, the second leg of the deal is very much on the table. SoftBank hasn't, suspended talks with Flipkart on that front. So we might just see a deal happening as far as that is concerned. But to really give us more details on what Kunal Bahl's plan of action is, Rahul Dama joins us from the ET Now newsroom in Bengaluru. Rahul, what is Kunal's action plan? What is he going to do as part of this Vision 2.0 strategy?
Chandra, as you pointed out, apart from really assuaging concerns of employees at Snapdeal, because cost cutting will be imminent now, Kunal has laid out a sort of a detailed plan as far as revamping and pivoting to another model is concerned. It will largely be on the lines of Taobao in China, a more C2C sort of a platform, an open marketplace that eBay was. So in the letter to employees, he's elaborated why the deal couldn't get through. There are three basic reasons for this. One, that the deal was intensely complex. Secondly, that it's not only one sort of a business model that will be a winner in the Indian e-commerce market. So his strategy is now to pivot and help anyone set up an online business in a matter of minutes. That's something Snapdeal did initially also and will be going back to it because it will not really require investments into fulfillment centers, training your on-ground personnel is concerned, and the margins are slightly better. How will they really do it is a matter of concern, and how that will pan out over the next few months. Also, he has spoken a lot about profits. They say that as far as gross profit is concerned, they are better off now, and in the next 12 months are targeting a run rate of 150 crores in gross profit. So back to focus on profitability, revamping their business and focusing on their strengths. Lastly, as you pointed out, news of layoffs that would eventually come by. He has stressed that cost cutting will be imminent, and the focus will be on a more leaner business that could suffice and grow their business on a profitable basis month on month. So it's really going back to the basics. As far as employees are concerned, something will definitely come out because operational efficiency will entail some sort of a cost cut, and employees will definitely have to bear the brunt. Snapdeal 2.0 it is. How it will pan out is something we will have to wait and watch.
Right, Rahul. Thanks for that. I'm sure it's something that we will be tracking closely as well. But coming up next, we have a very big voice as far as the story is concerned. She's spoken exclusively to us on this development. We have with us Vani Kola, one of the most influential investors in India, the managing director of Kalari Capital, one of Snapdeal's earliest investors and its former board member. Vani, thank you so much for taking out time and joining us on ET Now. This was pegged as the biggest deal in consumer internet in India. It's come unstuck. What is your own take on this development?
In the last few months, these continued leaks, the sources of which, I can only speculate, has been, in fact, very disconcerting and stressful to me. Keeping in mind confidentiality and best interests of the company, I have to date refrained from making any comments. But today, in reading the following statement in the news, that the company has now decided to pursue an independent path and is terminating all strategic discussions, I am extremely disappointed and shocked, in fact, the founders and their disregard for investors and employees' interests. I had no prior information of this. This was not discussed with us, and it has not received our support. And my disappointment is primarily also because I believe that these actions harm the credibility of our nascent startup ecosystem in India.
Right. Vani, where is this disappointment coming from? I mean, I know you have constraints as an investor, as a former board member, so you don't want to get into details. But, is it the fact that there were hectic negotiations, due diligence, revised offer that went on for a period of 5-6 months, and then the founders decide that, we are not interested, we will do what we want alone. Where is this disappointment coming from?
A company exists for all its shareholders, and not one set of shareholders only. So if we look at the majority shareholders and what is in their best interest, I believe that what happened today is not in their best interest. That's my personal opinion, and I understand that various people will have different opinions on this.
Vani, this deal was also supposed to trigger a big consolidation in the Indian e-commerce space. Now that it's not happening, what does this really mean for the future of e-commerce in India? I mean, this has been a winner-takes-all market, in all mature countries. So how is it going to pan out in India? Is there space for multiple smaller versions of e-commerce companies to exist?
Well, platform plays are always different from vertical opportunities. I think there will be many vertical e-commerce companies that can succeed as long as they have a very focused offering, either by a particular experience they offer to their customers or by a particular category, whether that's furniture, jewelry, lingerie, whatever the case may be. So I think there is continued opportunity for private label and vertical e-commerce companies. However, for a horizontal company who needs to offer everything to everyone, you can't have many such companies in play. That has been proven world over. So I think consolidation or not, we will continue to see more monopoly of few companies versus many companies on a horizontal platform.
Thank you, Vani, for taking our time and sharing your very candid thoughts on exclusively on ET Now. We are in fact going to take this discussion forward with three special guests we have on the show. We have Mr. Vaideshwaran, one of India's in fact first e-commerce entrepreneur and now the author of Failing to Succeed. We also have K. Ganesh, who wears twin hats of a serial entrepreneur and investor. We also have Anil Kumar of Redseer Consulting, a firm that looks very closely at this space. I'm going to start with you, Mr. Vaideshwaran. This is a discussion that we had last week as well. Why is it taking so long? Are they playing hardball? After, seeing this final statement coming from Snapdeal, what is your own sense of why this has happened? Is it, the founder going on this big ego trip? Is it something else? What is your own take?
Yeah, so Chandra, it's very hard to comment exactly what are the specific reasons why the deal didn't happen. I mean, if you remember, we spoke last time, and I told you that from one of the questions you asked me is why is the deal getting delayed, and my point was that typically all these deals get delayed if one of the parties is not keen on making the transaction happen. Clearly, Flipkart was not keen on making the transaction happen because it wasn't in their interest and they were hardly getting any assets. So that was the reason they didn't get the deal to happen. Perhaps that led to other things. There was also some speculation whether Snapdeal is in talks with other people. Infibeam was briefly mentioned in the media a couple of times. I personally told you last time that it didn't make sense for Infibeam to get into B2C e-commerce. I won't be surprised if there are other deals that are happening. Recently, they went and sold Freecharge. The money comes into Snapdeal, gives them a little bit of a runway of a few months. So while all this Snapdeal 2.0 could be posturing in the marketplace, I think what it also does is gives them time to go pursue other options in the market. I mean, I won't be surprised if there's some serious large offline retailer talking to them right now, even as the other things are breaking in the media. So I don't think this is the end of all deals for Snapdeal. There may be other deals that could be happening.
Right. K. Ganesh, I want to get in your view on what Vani Kula said. You know, she's made a very strong statement to us. She said that she's extremely disappointed and shocked with the founder's conduct and that this could be bad for the startup ecosystem in India. It's you know, almost a loss of credibility. Would you agree there? You know, after sitting in for negotiations for 5-6 months, sitting through 2 offers, 1 revised bid and multiple levels of due diligence, they've decided to just walk away. So, you know, how much of the blame here really rests with the founders? Would you agree with what Vani says there?
Yeah, hi. So, Vani is a very seasoned entrepreneur and an investor. And I really don't know what is the dynamics inside between the founders and the investors in this particular case. But I have a lot of respect for Vani. So I do for the founders too. I don't share the same sentiments in terms of being bad for the ecosystem or for the startup. Deals like this are complex, have multiple parties, have founders, have investors who have come in at various stages of the life cycle. And in this case, we also heard it had an investor like SoftBank who was pushing for the deal because he also wanted to invest in Flipkart, which was not the case with the other early stage investors. So given the complexity of the deal, the number of players involved in the deal, therefore it is complex. And it is perfectly fine for a deal as big as this is the biggest deal in the e-commerce space to go through hiccups and fall off. I don't think it has got any more implication on anything else. Now, what was committed by the parties to the deal, that they will consummate it in good faith, and term sheet was signed, due diligence was done, then people back off, does leave a certain bad taste in the mouth for people involved, because normally you expect term sheets to consummate. Okay, you don't expect it to fall off that easily. But I really would not know the mechanics of it. From a startup entrepreneur ecosystem point of view purely, I think it's positive that the founders feel that there is a way to build a company independently, are confident that either with the money they have or with the money they will be able to raise from new investors, if any, they would be able to go at it full time. They also fully realize completely the challenges of raising money. So they are iconic entrepreneurs. So I think given great investor and iconic entrepreneur trying to do this, I wouldn't say there will be any fallout of this. I don't think I agree with Vaidiswaran in terms of the other offline players trying to look at it. Typically, the offline players, they would never be able to pay anywhere near these kind of valuations being talked about. So I would be very surprised if that was happening.
Right. Vaidiswaran, you want to counter that quickly before I go to Anil Kumar? Ganesh believes that the valuations will really be too steep for any offline player to step in here.
Yeah. So Chandra, no need. I'm not countering Ganesh. I fully agree with him. I think the point I made is that the money that came in through the Freecharge deal essentially gives Snapdeal a little bit more runway to go and do a deal. I have no doubt no offline player would write a $1 billion check at all. I mean, the fact of the matter is, and if you remember our discussions last week, I clearly said that there's really hardly any assets that Snapdeal has which is worth anything to Flipkart. There may be some value of it to an offline player, such as the fact that they've built a website that draws a certain amount of traffic. No offline player has got that so far. They built a reasonably robust e-commerce platform. They've got people coming and transacting on the platform. None of the offline retailers have promised or managed to succeed in that area so far. So there is some value, but it's certainly not $1 billion. So I agree with Ganesh. I think the deal, discussions may happen. Deals may or may not happen, but certainly it's not $1 billion valuation. It never was, even in the case of Flipkart. I mean, if Flipkart was paying, the question is, if Flipkart was paying cash for Snapdeal, would they pay $1 billion? The answer is absolutely no. I mean, they were doing $1 billion because just paper going out in cash. I mean, you would be willing to pay any paper if it gets in cash. Nobody would pay cash for $1 billion for Snapdeal, not even Flipkart.
Right. Right. Let me get in our third guest, Anil Kumar of Rexia Consulting. Anil, you look at numbers every month of all these big e-commerce companies in terms of market share, in terms of GMV. Now, Snapdeal 2.0, from what it appears, it seems to be something like what a Taobao does in China in terms of an online marketplace where, multiple sellers can list and, the onus of fulfillment, doesn't fall on Snapdeal. It seems to be a Taobao-like model, which is why they're talking about a stripped-down version of Snapdeal, very few resources required. Do you think, it can be executed in a market like India with minimum resources? Now, Snapdeal has, the $60 million from Freecharge. They are possibly looking at a Vulcan Express sale. I'm not sure of another investor entering the picture at this point, but is it possible to run this business independently without getting in the way of, say, an Amazon or a Flipkart, where the stakes are much bigger, much higher, you need more money every month?
Sure, Chandra. So, okay, so I think looking at the numbers of what Snapdeal and what specifically Snapdeal has been doing, I think in terms of overall number of transactions and the number of visitors, obviously that number has come down quite a bit since last January of 2017, right? So, but if you still look at from an absolute point of view, this is a significant number. So they would be definitely fourth or fifth most busiest platform in India in terms of the traffic and the kind of GMV and other metrics which they generate. So with that fact in mind, right, and the factions which you spoke about in terms of the money which they already have, the money coming from Freecharge and so on, definitely they have a head start, or they have a point from where they can start and execute a new model. So that's not something which I'm really doubtful about. But the question is, what is the end game? Is that something which they can, can they get back into the top 3, top 2 e-tailing players which they were earlier? Not even in the next 1 year, 2 years, 3 years? No, that's the big question, right? So there are two scenarios which we're talking about here. One, they leveraging the current traffic and the existing cash with them to create a business for themselves, which might or might not be a really big business. Or second, that they actually rise like Phoenix and sort of come back as a top 2 or top 3 player rivaling the Flipkart and Amazon. Standing here in my mind, the second scenario is very bleak, and the first one is definitely possible. Why I'm saying so is, obviously because of the dynamics which you've seen already, but apart from that, the market is not that mature enough right now that it can do a C2C play, because the customers need a whole lot of trust for doing e-commerce shopping, and we still see, as we speak to the customers and the whole overall ecosystem, India is still like a couple of years away from when people really trust the online platform. And if Flipkart and Amazon have to prove it, the C2C platform would come in only 2 to 3 years later. So from the market maturity perspective, Taobao is still away from the what marketplace model would be. So in a nutshell, my answer would be yes, they can have a good business. Maybe they can create a few $100 million of GMV or maybe more. But if you have to look at rivaling some of the leading players in the market.
So in terms of... Right. So basically you're saying that in terms of scale, it's very difficult for them to claw back to where they were, as a credible rival to Flipkart and Amazon, but maybe they can build a much smaller version of their business. I mean, I don't know if Snapdeal founders will be happy with that, or if they are going to look for another investor to, bring them back to the same heights. Because after becoming a unicorn, I'm not so sure they will be happy with the current scenario. But Ganesh, let me take it to you. The other theory, that people are talking about is Flipkart just made it too difficult for this deal to happen. I mean, this 100% approval, from what I hear, it's not just SoftBank's condition, but also Flipkart's condition. In a company that has 20 to 25 investors, how can you get 100% approval for a deal to go through? Then, there was the matter of a lot of indemnity clauses, other clauses. So did Flipkart really make it impossible for this deal to happen in a sense?
Yeah, I actually don't know the details, but I don't think so, because indemnity from people who are selling is a given, okay, right? It happens in every case. Now, what is the limits on indemnity, how many years, all that are questions that get negotiated, but I have not heard or seen any deal where indemnity has not been given by the selling shareholders. Because if the company acquires, when Flipkart acquires Snapdeal, after that Snapdeal has got an issue, the owner is Flipkart. I mean, their interest needs to be protected by the indemnity from the selling people. So that is very common and normal. And similarly, asking for 100% of approval, there are 25, 30 shareholders. Again, it's very common. See, why would a shareholder not approve? See, if you are buying, it's almost like you are buying a house. If you are buying a house from 5 or 6 people who jointly own the house, you want to ensure that all of them sign, okay, right? You don't want to take a chance. Because tomorrow if somebody puts a case, somebody comes up with an objection, it is unnecessary nuisance. So again, I have seen deals where whenever there's acquisition, 100% has been insisted and it's easy to get. It's not impossible to get, because ultimately not everybody would be happy signing it, but they know there is no choice. Because this is the best deal available, the majority feels this is the best deal available, the founders feel it's the best deal available, then smaller shareholders join in. I mean, I have sold companies to US listed companies where we had to get multiple shareholders. Some of them are reluctantly they agreed to the deal. So I don't think Flipkart has made any demands which are not usual or which can be considered as onerous.
Right. On that note, I'm afraid we're completely running out of time. I personally would like to discuss this a lot longer. But thank you so much, Mr. Vaidishwaran, K. Ganesh, as well as Anil Kumar, for joining us on this leg of ET Now Startup Central to analyze what is India's biggest e-commerce deal that never was. It was a deal that came unstuck after months of negotiations. Thanks so much for watching this edition of Startup Central. Stay tuned to ET Now.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.